Hi, today we will identify, explain, and link the concepts that we have learned from Chapter 1 to Chapter 3.
Hi, my name is Farah and I'll be talking about what we have learned in Chapter 1 of Business Accounting. We started off by understanding what is accounting. Accounting, it is a process of analyzing, recording, summarizing, reporting, and interpreting financial information of a business. It provides accounting information known as language of business to, firstly, managers, to identify the daily operations of the business. Secondly, owners, to know if his or her company is making profits. Thirdly, to employees, to know if the business is making profits. Fourthly, investors, to decide whether they should invest with the company. Fifthly, to creditors, to see if they should continue business with the company. And lastly, to tax authorities, to tax the company that is making profits. Moving on, we were introduced with the 5 elements of accounting, namely assets, liability, owner's equity, revenue, and expenses. Assets are properties of values owned by a business such as cash, office equipment, office furniture, and many more. And for liability, these are debts owed by a business. It could be a loan from the bank called bank loan or even account payables. And for owner equity, it is the owner's claim on net assets of business, such as shares. Additionally, owners of a company are called shareholder equity. For revenue, it is the amount earned from selling goods. Revenue leads an increase in profits, which causes an increase in shareholders' equity. One example could be providing consultancy services. And for the last element, which is expenses, these are costs incurred for the goods that the company buy or use. Expenses decreases profits, therefore shareholder equity decrease. One example could be renting a space for your business to operate. Now that we know the basic elements of accounting, it is important that we follow the basic equation, which is assets equals to liabilities plus owner's equity. It could also be classified as A equals to L plus OE. This is the foundation of a double entry accounting system. The accounting equation shows a company's balance that a company's total assets are equal to the sum of the company's liabilities and shareholders' equity. Another equation that you might come across is assets minus liabilities equals to shareholder or owner's equity. For the last point, we learned 3 accounting concepts. The first one is called accounting entity concept. Owner and business are separate business identity. Therefore, owner personal transactions are kept separate from business. Secondly, monetary concept. Transaction will only be recorded if it is measured in monetary terms only. And last one, historical cost concept. Only to record transaction for the actual amount paid. Amount paid will not be adjusted due to inflation or market changes.
In conclusion, Chapter 1 allows us to know the equation of A equals to L plus OE, which will be useful in preparing financial statements in Chapter 3 to check whether the transactions tally. And also, by knowing different types of transactions, whether they are an assets or liabilities. It gives us a clearer mind of double entry system in Chapter 2, which will help us in doing the general journal to know what to debit and credit, and helps us to identify what are the temporary accounts in Chapter 3 afterwards.
In Chapter 2, we have learned the following. Double entry system is an increase and decrease in each item of the accounting equation by accounts. All accounts found in general ledger. Listing of all accounts called chart of accounts. Formats for accounts. First, T account format. Second, columnar account format. Rules of a double entry system. Assets you record on the left side equals to liabilities plus shareholders' equity record on the right side. When asset expense increase, you debit. When liability revenue shareholders' equity increase, you credit, and vice versa. When sales return increase, you debit, and when sales return decrease, you credit. Accounting period concept refers to lifespan of businesses broken into regular intervals. Financial statements are prepared at the end of each accounting period. Going concern concept, you assume business continue to operate for a long time. Assets value at historical cost and not at disposal value. Disposal value refers to market value. Transaction analysis, these are the steps as follows. First, accounts affected. Second, category. Third, increase or decrease. Fourth, apply rules of debit and credit. Fifth, amount to be recorded. Journal refers to book of original entry. Records information in chronological order. Debit entry of transaction recorded first. credit portion of transaction is indented and placed below debit entry. Explanation of entry: total amount of debits equals to total amounts of credits. Each transaction must affect at least two different accounts. Posting journal entry to general ledger. In this example, in the general journal, we debit cash 80,000, whereas we credit ordinary share capital 80,000. To post the transactions of ordinary share capital from the general journal to the general ledger, under the cash heading or table in general ledger, we write ordinary share capital debit 80,000, leaving us with a balance of 80,000 debit. Repeating this pattern under the ordinary share capital heading or table in general ledger, we write cash credit 80,000, leaving us with a balance of 80,000 credit. In general journal, we debit inventory 10,000 while we credit cash 10,000. We repeat the same pattern that I mentioned earlier, except this time, since the cash table in the general ledger already has a balance of 80,000 debits from the ordinary share capital, to find the balance of the inventory under the cash table, since we credit 10,000 for the inventory, the balance of the inventory will be 80,000 debit minus 10,000 credit, giving a balance of 70,000 debit. This pattern follows for the subsequent values to post the transactions from the general journal to the general ledger. Preparing pre-closing trial balance, list of the ending balances of all the accounts in the general ledger. Total debit balances equals total credit balances. To prepare a pre-closing trial balance using the balances in general ledger, we transfer each heading and the final balances in each table in the general ledger to the pre-closing trial balance. In this example, there's a table with the heading cash in the general ledger. The final balance of this table is 88,000 debit. Hence, we transfer the heading cash and this balance of 88,000 debit to the pre-closing trial balance. We repeat this pattern for subsequent headings or tables: ordinary share capital, inventory, bank loan, accounts payable, joins respectively. Finally, we total up the values from the debit and credit columns respectively. They should balance.
In conclusion, Chapter 2 is very crucial as it links to other chapters. One example is we learn how to construct a trial balance. We can shorten the process of presenting a financial position in Chapter 3. Hi, I'll be explaining the concepts for journal entry of closing temporary accounts, statement of profit and loss, and how to transfer profit and loss to retained earnings. People may wonder, what is the purpose of preparing a statement of profit and loss? Well, it's important for companies to know how much they have earned within that specific time frame. It shows the profit or loss during that financial period. To prepare the statement of profit and loss, we need to identify our temporary accounts, which is revenues, contra revenues known as sales returns, cost of sales, and operating expenses. To find out how much a company earns, the revenues will minus off the cost of sales, sales returns, and operating expenses. An acronym that can be really helpful is NSGP-MP. First, revenue deducted by sales return will give you net sales. Afterwards, deduct cost of sales, which will achieve gross profit. And lastly, deducting operating expense and net profit will be achieved. A misconception can happen, which is people thinking that the left and right column are debit and credit column, but this is just not true, because they are just the working column and final column respectively. Now, some companies may request to prepare journal entries instead. This is largely similar to profit and loss as it identifies whether a company is making profits. However, there are two differences. 1. The left and right column is known as your debit and credit column now. 2. You remove the statements like net sales, gross profit, and net profit and replace it with profit and loss at the bottom. Now, how does it work? Debit sales revenue and credit sales return. Debit, credit, cost of sales and expenses as well. The debit will deduct the credits. Debit profit or loss if it is a loss, and credit profit and loss when it is a profit, because it will denote whether expenses are more than income. Before preparing the financial position and post-trial balance, we need to transfer the profit and loss to retained earnings, which are known as net income earned in that particular financial period. We must be clear that retained earnings may not be zero always. There are times where there are values for retained earnings account from the last period. But we do not include and add up the retained earnings and profit and loss together. We only add up during the post-trial balance and also the financial position.
In Chapter 3, we learned about the Statement of Financial Position. The Statement of Financial Position allows companies to find out how much assets, liabilities, and shareholders' equity they possess. We have learned that from the trial balance, after preparing the statement of profit and loss, only the assets, liabilities, and shareholders' equity are left. We prepare the Statement of Financial Position by following the accounting equation, which is assets equals to liabilities plus equity. we list out all the assets that we have, tally them up, and then do the same thing for liabilities and equity, and then add the amount of liabilities and equity together. The assets should equal to the total liabilities and shareholders' equity, and if it adds up, we have prepared the statement of financial position correctly. We also learned that to prepare the post-closing trial balance, since the temporary accounts from the pre-closing trial balance are all closed off, we only have the permanent accounts left. The post-closing trial balance consists of all the permanent accounts, as well as retained earnings that we calculated from the statement of profit and loss. So, it is actually very simple to prepare. We just remove all the temporary accounts used to prepare the statement of profit and loss, and then list the permanent accounts as written in the pre-closing trial balance, and just add the retained earnings inside below. In the self-test and tutorials, we practice a few things. In self-test 3.0, we practice how to prepare the statement of profit and loss, as well as the statement of financial position. And in self-test 3.1, we practiced how to close temporary accounts through journal entries, transferring the profit and loss to retained earnings, and finally, preparing the post-closing trial balance. We did the same types of questions in tutorials 3a and 3b as well. Finally, this chapter is important because we need the knowledge learned in chapter 3 to understand other chapters in future. For example, it is also linked to chapter 5 because in chapter 5 we learned about adjusting entries to the trial balance, and we cannot adjust entries if we cannot prepare the trial balance at all.